The fifth fastest sell-off of all time. This is what we witnessed over the last couple of weeks. Now is it about to change? With a 90% uptick in stocks moving last week in terms of bullishness, are we about to witness the bottom being put in? In today's video, we talk about the short squeeze that we discussed in the previous video and how everything in technology is just way too oversold. On top of that, we need to take a look at what's happening with the dark pool activity at epic highs for things such as gold and other stocks, and of course, discuss the bonds market. It looks like there's still some concerns, and until this changes, we may not be able to bottom. What is the 100% stat that we've seen before that happens next? In today's video, we'll talk stocks, commodities, and cryptos for the weeks ahead. Well, welcome back everyone to the special weekend edition of our daily show. My name's Tom, and in today's video, we have a lot to discuss. Some 100% statistics that you need to know, Nvidia potentially breaking out and pushing positive gamma, and of course, the latest macro data and key levels. Whether you're an investor or trader, make sure to subscribe if you haven't already done so, as 2025 could be the most important year that you've ever been involved in markets, and we'll be talking about it more throughout what is going to be a very volatile year. Let's talk about, though, breaking records. We said 2025 would be pretty wild. We knew there'd be a sell-off of around 10%. It was statistically likely. And we also knew that it was likely to happen in Q1. We discussed this late last year. But what we didn't know was the speed. And yes, we've actually hit the fifth fastest sell-off ever recorded in terms of speed towards a 10% correction. Now, what does this mean? Well, it's starting to actually bring one of the most extreme oversold signals in history. And you can see it started to turn up on Friday as 90% of stocks thrust upwards instead of going down for the first day in a while. Now, this alone is an interesting stat, but take a look here at all of the previous times this has happened according to macro charts and how it was the bottom point of many markets. Now, why is this important? Well, we need to continue to build the evidence. Not only do we want to see structural breaks, which we'll talk about later on in today's video, but we also want to see whether stocks continue to increase. And with a 90% upward volume tick, this is already pretty good. You'll notice here that generally we at least see a bit of follow through that tends to happen here, and sometimes we get epic V-shaped reversals. And a lot of you guys are probably looking for one of these epic V-shaped reversals, similar to what we saw in 2024, with everyone jumping on board and a short squeeze commencing. We talked about this in our previous video, and we said maybe this is an area that we might see a little bit of short squeezing, and then we got one of the biggest upward thrusts we've seen in years. Now, why is this important? It's about stacking the evidence in our favor. These are all the 90% upward volume days we've had over the last couple of years. And of course, these are what it's about. It's about having multiple upside volume days in a short period. This is when we've had 80% upside volume days after a 10% drawdown within 10 trading days. So that is that we have them all around the same point, and it shows us that even if the market's not going up that much in terms of actual movement, that we're getting a slight positive buy type of attitude. It's been sell, 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 negative media. We often say if it's in the press, it's in the price. Everyone's still incredibly negative on the economy. Everyone's talking about a recession. Everyone's saying the world's going to explode and all these things. But still, we end up going back to the data. And that's what this channel is about. It's about price action. It's about taking out that type of stuff. And of course, taking the emotion out of trading and investing. If you like that stuff, make sure to continue to follow us as well. This is a big one, 80% upside. Will we get 3 days in a row? That could be another good tell. We'll keep following that one. But does the evidence continue to stack up? Well, equity put call ratios, if you're familiar with markets, can be a pretty good read. Basically, what we're looking at is too many puts. Do we have too many puts in the market? Too many people going with the negative and basically saying this market is cooked, it's done, it's over? And is that happening on the S&P 500, 10% below the 52-week high? Well, again, it's just triggered something that tends to have a 100% statistic behind it. And of course, you could say, well, this time's different, but there's a couple of reads here, and you'll notice 6 months and 12 months later, wow, the stats are pretty good. In fact, 2 months later, 92% of the time, markets were actually bullish, and there's some great base structures here. But if you notice, there are a couple of base structures here where we still end up making lower lows. So don't necessarily think that the market's done selling off. It is still possible for us to sell more before actually finding rallies. And this is going to be why we have to be so careful with the price action and, more importantly, the options levels. Let's now discuss sentiment. It's one of the worst we've ever seen, one of the worst we've seen since the global financial crisis, and really only marked by generally what has been bearish markets. That is 20% down. We're only 10% down at the time of this recording, even less now. And we can see that the sentiment has gone so bearish due to the actions of 2025. We've got so many people with differing opinions. Everybody's got a different opinion on where certain things are going in the world. And obviously that's driving into sentiment in the markets. When we take a look at the sentiment being so bad, it's only ever happened twice. And that is 2 times in history have we ever actually seen 3 reads with less than 20% of those reads being bullish. Yeah, only less than 20% of respondents have been bullish over the next 6 months. And when we've had that, well, again, we've got another 100% stat over the next year, but things have been relatively shaky, you would have to say, from this stat alone. Again, 2 data points isn't going to make or break it, but it's an interesting one nonetheless. We've shared that a couple of times. Here's one, though, that I think most of you probably haven't seen. And yes, it does come from the epic bull himself. Yes, Tom Lee. I know a few of you will put in the comments, oh, this stupid stat from Tom Lee. Always bullish, but still very interesting. The fastest corrections, the 5th fastest correction of all time, equaled here by the Volcker shock and the Asian financial crisis. All of them have led into gains over the next 3 months, 6 months, and 12 months. And the reason why this could be true again is in 2 of the biggest bull cases this year: deregulation and tax cuts. Now, while they may create sugar rushes in the market, remember, if they do get passed, and arguably there is a higher chance that these things may all get passed based on what we just saw happen with the debt ceiling, that we could be looking at a market that's going to be loving life in only a few weeks. And this is one of the things that I think is very important to keep in the back of your pocket. It's not really about our opinions. We could be completely wrong on this, but we want to be watching the price action, the flows, the dark pools. Do what they are saying, but do what they're doing, not what they are saying. Never do what they are saying. We don't want to be doing that. Do what they are doing. And of course, we can see that through dark pools. Speaking of this, too many people are short. Let's have a look at this one. We shared it last week. We obviously thought that we were going to get a potential short squeeze. And this is because too many people are again leveraging to the downside. So if you do get epic upside risk, what happens? Well, all of a sudden these people have to hedge themselves off, and it can be pretty epic. In fact, we've just seen one of the biggest buy the dips in years. The largest weekly inflows to equities ever from GWIM clients, according to the latest Bank of America investment strategy survey. Have a look at this. These client inflows are big time. And you may notice some of these dates. September 22, not quite the low of the market, October being the low, I believe, but then we end up getting a rally. January 21, close to that epic big bull FOMO that was actually being caused by the ARK-K funds and the hypergrowth funds. That ended up going bad, but then went much better afterwards. And of course, this one, the March 25 sell-off of 10%, the 5th fastest sell-off of all time. Do we have some other reasons to believe, though, that the markets are potentially oversold? Well, technology is completely oversold. We've got here one of the biggest bearishness levels on tech since the last couple of years. And when we tend to see these types of bearish levels on tech, we do get relief rallies. We also showed that XLK, less than 3.5% of stocks in the XLK were above the 20 moving average. And this is pretty low. In fact, it usually does cause a bounce. And of course, it's something that we showed at the start of today's video. And to make matters even more crazy, 3 standard deviations away from the 50 DMA. Very rare. Pretty much we haven't seen this. You know, you can see here the last couple of times, as Seth Golden has here. And yeah, it's just such a rare statistic that you've got to start saying, well, maybe we can get a relief rally. And obviously this was done at 55.35. Currently the market sitting about 5,600. We also saw Nomura come out and say that they believed a short squeeze could be possible according to their latest kind of investment data. And this is, of course, maybe what's happening right now. And from our technical level as well, we've had a 61.8 hit on both the S&P, RSP, which is the equal weight, and the NASDAQ. So a lot of things kind of going with this oversold statistic. But can it get even better than that? What about what they're doing, not what they're saying? Well, the dark pools started to activate again. While these weren't necessarily dark pools, large transactions right at the low of both IVV, which is of course one of the biggest S&P 500 funds, and also a huge transaction on the Qs as well, all near their lows. And so far, the action has represented a bit of a turnaround. Now, you may remember only about a week ago, we saw 5,700 on the S&P being defended by lots of large transactions. A lot of you may think, well, those people have lost. No, I don't think so. I think they were buying the 200-day moving average, and they know the stats around the 200-day moving average, which we'll look at later on. There's a good chance that the market will want to bounce back to that level, which currently sits, I think, about 57.35, and this could be the time it's going to do so. So, of course, things starting to improve across the board. Where you've got to be more careful, though, is the one that everyone's looking at. Now, we love gold, and we'll give ourselves a clap because 2 years ago, pretty much to this date, we were talking about gold. We were loving gold. We obviously were super bullish on it, and we thought it was one of the best assets that you could be in. Well, we just hit our first target, which is $3,000 an ounce, and we do know that gold has problems around these $1,000 increments. Guess what? Fourth largest dark pool transaction just cleared on this particular gold fund. And there is a huge amount of potential profit takers coming in. They like 3K. I don't blame them. And while I do think that gold will go further than this and probably hit 3,600 plus, let's be real, somebody's probably taken some profit at these zones. Now, could we see a turnaround also based on the tariffs themselves? This is the concern that most of the market has. And of course, there are other big concerns out there. But have a look at Trump tariffs 2.0 with Trump tariffs 1.0. Remember, this actually was in 2018. This is actually how the market reacted over that period of time. And that looks eerily similar when you think about it. We actually turned in around the third week of March and ended up going on this epic rally kind of gain until the end of the year, which went, by the way, terribly. And that was one of the biggest sell-offs in tech that we had in years. So just remember, tech back here, if we kept going on this chart, was absolutely terrible. But over here, there was a big, big recovery. So could we be following kind of what we've been doing so far? Certainly a cool chart and something that you could consider looking at. Let's now also talk about crypto for a minute here. No signs of inflows yet into the crypto market, but price has improved on Bitcoin, which we'll talk about later on. Let's now take a look at rotation. How was Friday? Well, it was up in all the right spaces. Semiconductors, up. Technology, up. The oversold markets. And of course, weirdly, energy up as well. But we did have regional banks and financials holding as well. And do remember that financials, XLF, one of the most important sectors. This is important to actually not lose its price action levels. And if you load XLF, and I highly encourage that you do at some point, you should check out where its support is. Because if we lose that level, another big warning sign for markets. And we've already lost one of them, which is home builders, and we'll talk about that soon. Home builders not looking so good. Let's now take a look at the last 5 days. You'll see here the defensives, mostly in the bottoms. And of course, gold, geopolitical stuff, utilities, semiconductors now green on the last 5 days. And that's kind of showing what we already started to see underneath the hood, which was that Nvidia in particular was picking up for a couple of days as the stock market kept making lower lows. And what that was telling us is that somebody went and said, you know what, this looks pretty cheap to me. I'm thinking about buying that oversold dip. Now let's have a look at the S&P from that same perspective. We'll click on the weekly and you'll notice that it has pretty large wick. And what we're focused in on is this wick realistically. Now you might say, but Tom, look, the wick was up here and it didn't do anything. Well, the key to this wick is to think about where it's at and also to think about what it could be going for. We've sold off at one of the fastest rates we've ever seen. We have put-call ratio. We have puts everywhere. We have, in general, a 90% upward thrust. Could we be going towards the 200-day moving average? Well, of course, this is the one that I think a lot of people will be looking for. And the 200-day moving average at the moment sits at around 57.30 to 57.50, depending on the chart you're looking at. Now, why is this important? Well, because whenever you lose the 200-day moving average, you generally have to come back and at least tap it. At the same time that you hit that level, you're going to be hitting the 20-day moving average as well. And this is a pretty important zone. So all of these levels together are going to be sitting and waiting for this week. And we'll, of course, talk about the structure in just a minute here. But if you go back through the history and you look at the 200-day, in particular, you look at the times where we found resistance on them, such as here back in December of 22, when we had eventually broken it by a lot, it was the turning point for the markets, and markets continued to rally. It's a really, really important indicator. And as you can see here, it's one of the ones that's the best when it comes to really figuring out whether a rally is real or whether it's fake. So we'll be watching it very closely over the next coming weeks. And I do encourage you to also have a look at it as much as possible. It's not the be-all and end-all. It's certainly a great indicator to be stacking that evidence with. These are the latest options moves for Monday in terms of what the market is expecting 68% of the price to stay within. And these are, of course, still the most traded and the gap low level that we could be looking at. But let's take a look at structure. We have what could be a small Wyckoff base, and we have at the moment what could be a little bit of a coiling market underneath that all-important 5660 zone. Now, 5650, 5660 should be a breakout zone to push for that 200-day moving average and also to potentially push for just recovery in general. Now, why is it so important? Well, we didn't really quite do enough to completely change structure. We got above this high, which is important. We obviously pushed higher above here, which day traders may have liked. You know, that's a good level if a day trader was coming in on Friday and saying, you know what, I want to at least buy from here to here. And there were some nice little trades there throughout the session. But if you're someone that's bought the dip, you've bought a position, and you're like, you know what, near enough's good enough. We got close to the most traded zone, and I'm just going to buy the dip because I'm feeling it. Well, it still doesn't look too bad, but it certainly hasn't recovered yet. Let's have a look at the options. What does that say? Well, the options levels are kind of the same. We've got 5670, 5700 being the call walls. Now, if we get through those, guess what? Back in positive gamma. Markets could certainly squeeze, but you'll notice here that we keep getting the same levels. This is OPEX this week. So if I was the market maker, and I'm sure if you were as well, what would we be doing? We'd be trying to push the market above 5,700. That would be probably the best thing we could do to make as much money as possible. Now, can they do it? Well, we'll see. But 5,500, 5,600, and 5,700 remain the most struck put levels, and there are so many puts down below here. So really, it's all about trying to get that level back to above 57. If we can push that by a bit, we can go back to positive gamma and markets will be in recovery. As they stand, the bears are still technically in control. Let's have a look here at some of the other markets. Tesla, one of the most oversold, comes back to 250. You can see we'll turn positive gamma if we get through these levels. So right at resistance is where we find it. And if we have a look at Nvidia, you'll notice that it's really looking at a 125, 126. And we get through that, and it's going to be very, very strong. Take a look here at some of the expirations in general, and you'll just keep seeing 120, 125, 130, 120, 125, 130. So it certainly has come back. And that's, I think, testament to why, if you bought that most traded level, which we've talked about now for what seems like an eon, but I'm sure it's just been a few months, the 115, guess what? The market's back above it. Key levels matter when you stack enough evidence in their favor. But if you buy rando price, you will lose because you never get the opportunity to make a decision, because the markets will often come back to these levels, then allow you to potentially get out if you want to. Have you ever noticed that? Key levels matter. If you buy rando price, you will never have the opportunity to actually say, well, you know what? Didn't do what I thought. I'm going to get out of it for now. Now, one of the other things we're looking at for market bottoms is, of course, our indicator here, which has got to do with bonds and yield. And we are not seeing a sign that this is a bottoming market yet. Now, if this drops through Monday, markets break through those structural zones, we're going to like it. Of course, we're going to like it. But at this stage, the bonds are not telling us it's a buy, 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 buy. They're saying, you know what, still be cautious. We may not have changed structure. The VIX itself absolutely does look a lot better. You can see here the VIX has dropped off, come back to the 20-day moving average. Things look, of course, a lot better here with that crush on the VIX. And you've got to love a good crush on the VIX. It often can be synonymous with lows. Now, it doesn't mean the lowest lows in. Sometimes the VIX can actually go down like this, and the market can actually drift blow up, making a secondary low and then still rally through. So don't bet that that hasn't happened yet or can't happen, but the VIX does look good. What doesn't look good is ITB. Home builders, Frankly, I think it's a warning sign. This is not what you want to see for the longer term economy. And to me, it kind of tells me late cycle is upon us. We've gone through the mid cycle. We're at this kind of stage now where we've got to be still very defensive. And although gamma stocks and the big tech may come up first, because that's what we suspect, you've still got to be really, really careful. Let's have a look at the US dollar. The US dollar is still selling. At this stage, I would still prefer this type of movement, but we currently think the dollar is down for this year, and that's how it's been trading at this stage. What about gold? Hits 3,000. Congrats, anyone that's had it there. Beautiful. We did it. It took a while, but we did it. Beautiful, beautiful move by gold. But it does struggle with 3,000. It does struggle with $1,000 increments. And if you go back through and look at history, well, it can get through these zones. So if we go back through here and go to a weekly here for gold, you'll notice that we kind of hit around this 2,000 level. And we kind of struggle around that level for quite some time. So I wouldn't be surprised at all for gold to struggle around here. Does that mean I've gotten rid of it all and I don't think 3,600 can happen? No, but I do think that it is a target for a lot of people. And remember, if this dumps and goes underneath this low down here, then that's pretty much like a turn of trend in a Wyckoff, and it could get much nastier before it gets better. What about silver? How's silver going? Well, silver broke some key levels. I like silver. I think it's the better of the two metals in terms of pure risk reward at these standpoints, because it really should be about $40, $45 minimum based on where gold is. But yeah, 33.80, nice weekly closure. Daily obviously looks pretty good here. We've got a long leg doji. We're looking for a break above 34.08. If it does break that new high, I think it's got a little bit more length in it, even though it's getting extended, and that will be a good one to watch. US oil, for now, it's just all about structure, and it is forming structure. No real decision on which way it wants to make the next move. And Tesla, probably more about the weekly close. Look at that big wick. Big, nice wick coming off that low that we thought about, 250, 220 again. If you bought 250, you couldn't have been upset because it's flat now. So yeah, buy key levels, buy 220, 250. They were both pretty good if you're going to try to pick the dip. And for now, we're just trying to create some structure. And I think the most important indicator is probably going to be Nvidia. Positive gamma wall, 125, 126. And really, we're just looking at this stage at that 120 plus being a good change of trend. You've got kind of the island reversal here that you're seeing on so many of these big stocks. And if we go down to the 2 hour, you can see we got a higher high. That's the first time we've done that in this entire sell-off. So again, some positive signs coming out about Nvidia, and it is an important market for us to be checking. What about Reddit? Again, recovery after some horror sell-offs, island reversals, again with the gap down, gap up. And at this stage, I could see something like this going to 160. There are significant risks. There are no non-risks here. Of course, this stock is probably still overpriced at 128, frankly. But at the same time, we've started to see a lot of these stocks form bases. And we actually got this. Remember, we got this earlier. As soon as that Monday happened, the Tuesday came through, inside candle here, gapped up above that. Not the worst in terms of a pattern. So not too bad at all in terms of showing some strength there. Let's have a look at the mags. So this is the Magnificent 7. And again, decent structure here, big volumes, weekly, big bullish wick coming off the demand. So you can't hate where we're at. We're at that level that makes sense to find support structure over the next week or two. And maybe even we'll get a couple of positive signs with some kind of talk about tax cuts. I know tax cuts suddenly became a discussion point around Friday as markets start to turn. HSI, the Chinese market continues to be very strong. China's really capitalizing on this. What are they doing? They're just basically giving a bunch of stim. Every time the market even looks sad, it's like, you know what? We got some more stimulus for you. It's all good. So yeah, they've got a 5-year plan on this market, and it looks like you're only really into the first kind of 9 to 12 months of that 5-year plan. So still, I think a lot of upside for HSI, but I've said it before, 25 was certainly one of my targets originally, and we've been bullish on this one for quite some time. So congrats to anyone holding that. US 2K, enough? Well, it bought. It didn't really do anything. You'll see here, we've got a little bit of an engulf here on the daily. Nothing much to write home about. The 2000's been, of course, quite weak due to the debt-ridden businesses that it has in it. But some signs of recovery. Again, another one that's at the res but didn't quite break it through. I could see a lot of coiling with big decisions being made this week. So that's going to be something we'll have to track. And the NASDAQ is kind of the same thing. Let's load up the NASDAQ here. And you'll see it's kind of like a double bottom right at the resistance. Unable to really say exactly whether it's broken through or not. I do like, of course, the levels. We've talked about it before. But have a look at the overall wick. Nice wick coming through. Not really at a key level of support, just kind of the previous resistance, but still holding up. And yeah, 200-day moving average. Chuck it on the NASDAQ as well, and you'll see where it's at. Ethereum, no break of 2,000 means the bulls are certainly not in control. So bears are still in this, although some recovery lines. And I noticed on Bitcoin, take a look at this. It's just coiling at 84 and a half. This thing is literally just sitting at above these resistances, either getting ready for what has to be a big move. I mean, look at this thing. It just sits there. You gotta love how it's got all these key levels and it just keeps doing the same thing. It did come off the 50 weekly moving average EMA, which is always a popular one, but realistically, maybe that 84 and a half, 85, we get a nice closure above it and we can start pushing higher on Bitcoin. If it fails here though, guys, don't discount $68,000. I mean, it is possible. I hope it doesn't happen. I hope that if that happens, probably the market itself is probably going to cook down to some significant oversells. But for all intents and purposes, I think we're starting to get so many oversold signals that markets seem to be at least forming some form of bottom. And generally, if they're doing so into peak fear, that's not a bad sign. That's actually when, you should kind of employ that Warren Buffett concept. Although, if you look at Warren Buffett's portfolio right now, I think he's worried about a little bit more than the 10% correction. He wouldn't be in like 30% cash otherwise. For the week ahead, there's a little bit of news. The main one is Wednesday. So I'll show you here. It's FOMC statement, press conference, economic projections. The market's probably going to be looking towards the Fed for support. Will we get some mentions of that? I would say these are fairly important times. So these monetary policies from all these central banks, Bank of Japan, European Union kind of areas, it's all going to be about, do we get some stim? And I think that some central banks are going to be in for that. If you love today's video and you want to find out more about what we do, how we made decisions on gold, Chinese stocks, many other things over the last couple of years, then check out our flash sale, in particular the day trading masterclass and advanced masterclass will be really helpful for you. And of course, follow us over on X. Give this video a like, comment down below on what your favorite asset class of 2025 is. And I hope each and every one of you are having a great weekend. Thank you so much for watching, guys. There's so much to go through in markets over the next couple of weeks. And of course, we'll be there together to go through them all and to find those opportunities. Thanks so much. Bye for now.